Good evening, everyone. Today is January 14th, 2026, and the entire global financial structure has crossed a threshold we can no longer ignore. While most people were asleep last night, the silver price officially broke through $90 per ounce on trading screens worldwide. But here's the real shock. If you actually try to purchase a physical silver coin right now, reputable dealers are quoting prices north of $110. That gap alone should make you pause. Yet that discrepancy is far from the most alarming development. Right now, UBS, one of the world's largest and most influential banks, is locked in open conflict with the Swiss government, flatly refusing a staggering $24 billion emergency capital injection demand. This is the Basel IV regulatory nightmare materializing in real time. Simultaneously, the BRICS alliance has pulled the trigger on their long-awaited gold-backed digital currency, known simply as the unit. Meanwhile, the COMEX, the main exchange for precious metals futures, is staring down the barrel of an imminent default because there simply isn't enough physical metal available at these artificial paper prices. In this video, I'm going to walk you through the leaked and publicly verifiable data that mainstream outlets are either too scared or too compromised to report. If the majority of your wealth still sits inside the traditional banking system, the clock has just started counting down. Fast. Let's get straight into it. Just 7 days ago, on January 7th, an extraordinary event shook the silver futures market. One that directly ties into the larger crisis we're witnessing today. The CME Group, which operates the COMEX Silver Futures Exchange, implemented an overnight margin increase of 47% on silver contracts. Veteran floor traders say they haven't seen anything this drastic outside of full-blown financial panics. Picture this. You go to sleep with your positions comfortably margined, only to wake up needing an extra $2,500 per contract, or face forced liquidation before the market even opens properly. The margin hike was clearly intended to discourage traders from standing for physical delivery. Yet, despite that deterrent, 1,624 contracts demanded immediate physical settlement anyway. And crucially, this happened in January, a month historically known for being extremely quiet. Sophisticated participants normally just roll their positions forward to avoid the inconvenience and cost of taking actual metal. The fact that so many chose delivery in an off month is a glaring red flag. According to CME's own data, this pattern of backward rolling, actively seeking physical and quiet periods, is a classic signal of physical panic that the exchange desperately wants to keep under wraps. To help you grasp how serious this is, let's use a relatable analogy. Suppose you're planning a European vacation and head to a currency exchange to swap dollars for euros. Suddenly, the booth demands 47% more collateral than yesterday for the same amount of currency, and adds a 2-month wait for actual cash euros. You'd instantly realize the system is broken. That's precisely what occurred in the silver market on January 7th, but the consequences extend far deeper, straight into the foundations of global money itself. Now, let's go back a bit further. What major development occurred about 37 days before this margin shock that explains why traders are willing to pay steep penalties for immediate physical silver? On December 8th, 2025, the BRICS countries, Brazil, Russia, India, China, South Africa, plus their expanded members, didn't just announce or propose, they launched a working prototype of the unit, a gold-backed digital currency. The official statement confirmed they issued 100 units, each backed by 1 gram of physical gold held in secure, distributed vaults across member states. This isn't a concept on paper. The vaults are real, the gold is there, and the technology is operational today. What makes the unit's architecture so disruptive? Every cross-border transaction settled through the system completely bypasses the US dollar. A Brazilian soybean farmer exporting to China no longer needs to convert reals to dollars to yuan. They settle directly in units, backed by verifiable physical gold. Both sides avoid dollar exposure, SWIFT fees, and the constant threat of US home sanctions. Late last month, the World Gold Council reported that BRICS nations collectively hold more than 6,000 tons of gold reserves, more than enough to scale the system well beyond the initial 100-unit test. Fast forward to this very morning, January 14th. Silver smashed through $90 per ounce, while many of you were probably still having breakfast. But the headline price is only part of the story. The truly telling detail comes from the Shanghai Gold Exchange, where physical silver is trading at a $10 premium over COMEX paper prices. $10 isn't a minor glitch or fleeting arbitrage. It signals a fundamental fracture in the global pricing system. Physical metal in Asia now commands a significantly higher value than the paper contracts in New York that supposedly represent the same commodity. Imagine this playing out in your own portfolio. You hold silver futures on COMEX and feel good about your unrealized $90 gains. At the same moment, a trader in Shanghai can sell actual physical bars for $100 an ounce locally. That 10 spread is the market, shouting that paper and physical silver have effectively divorced, and physical metal is relocating to a new home without leaving a forwarding address. The situation grows even more concerning when we look at warehouse inventories. COMEX registered silver, the actual metal available for delivery against futures, has plummeted 70% since 2020, dropping from around 120 million ounces to just 36 million ounces today. At the same time, open interest, total paper claims, continues to rise. Basic economics tells us what happens when more claims chase fewer ounces. Prices explode or the system breaks. Right now, the physical market is showing painful real-world consequences. Over the past 2 weeks, Indian silver refineries and jewelry makers have declared roughly $425 million in insolvencies, according to the All India Gems and Jewelry Domestic Council. These aren't fly-by-night operations collapsing from mismanagement. These are long-established businesses crushed by margin calls they couldn't meet after the CME's 47% hike. This backward-rolling behavior reveals a profound shift in trader psychology. Large institutions with sophisticated research teams now view off-month deliveries as strategic, not wasteful. They're willing to absorb penalties, storage fees, and logistics hassles because they no longer trust the paper market to honor contracts at these suppressed prices. The CME's aggressive margin increase only confirms they share the same fear. Have you noticed the glaring absence of coverage in mainstream financial media? CNBC treats silver as just another commodity play. Bloomberg mentions industrial demand in passing. Almost no one connects the COMEX delivery pressure, the BRICS unit launch, and the broader threat to dollar hegemony. That silence isn't coincidence, it's deliberate. Here's the core connection that should reshape how you view your savings investments and future security. The gold-backed unit directly challenges the dollar, which relies entirely on confidence in the Federal Reserve and U.S. government, full faith and credit. When that confidence falters, as it did with the public revelation on January 12th of a criminal investigation into Fed Chairman Powell, demand for gold-backed alternatives surges. And when BRICS nations, which control roughly 50% of global gold mine production, offer a working dollar-free settlement system, the physical metal backing, it becomes priceless. The $10 Shanghai premium isn't random noise. It's the market beginning to reprice precious metals based on genuine physical scarcity instead of paper suppression. If your wealth is tied to dollar-denominated assets, retirement accounts, home equity, cash savings, this repricing impacts you whether you own silver directly or not. What we're seeing unfold is the rapid emergence of a parallel financial infrastructure, while the existing system reveals cracks it can no longer conceal. The margin hikes, delivery demands, premium gaps, these are not isolated incidents. They're symptoms of one underlying disease. The paper pricing mechanism is losing its power to contain physical reality. BRICS has built an alternative that needs no Western approval or bank intermediation. The only real questions left are, how quickly will this accelerate? And can legacy institutions adapt? Or will they resist until something shatters? The events of January 7th show the exchanges are already in defensive mode. Today's 90-plus silver price and persistent $10 Shanghai premium demonstrate the paper system is losing ground fast. Now let's examine the smoking gun that proves this is documented reality, not speculation. Of the 1,924 January contracts standing for delivery, 99% were settled by one institution, JP Morgan. Delivery reports show JP Morgan issued approximately 8.1 million ounces, basically the entire month's physical settlement, in a supposedly quiet period. One bank dominating nearly all deliveries exposes the true nature of the COMEX. Not a transparent, competitive marketplace, but a tightly controlled structure with a digital facade. This concentration should alarm anyone with a 401k, IRA, or pension. JP Morgan isn't delivering out of goodwill. They're doing it to prevent exchange default and total collapse of futures credibility. But their ongoing ability to deliver depends on vaulted metal or sourcing at prices near paper futures levels, and the Shanghai premium signals that second option is vanishing rapidly. The persistent backwardation in silver futures, where near-term contracts trade higher than distant ones, is another anomaly that shouldn't exist in healthy markets. It means the market pays a premium for metal now rather than later. Normally, suppliers would rush to deliver and arbitrage the difference away. That isn't happening. The tightness is structural. Consider a practical example. You're a solar panel producer in the U.S. You hedge by buying futures months ahead. Standard practice. Today, silver for next week delivery costs $92, while July delivery is $87. Suppliers should flood the market to capture that premium. They aren't. That tells you physical availability is far scarcer than paper suggests. The Indian insolvency wave illustrates the human and economic toll. These decades-old businesses weren't speculating, they were hedging legitimate risk. The overnight margin shock forced an impossible choice: find massive liquidity or shut down. Many chose closure, a damning vote of no confidence in surviving the new environment. Have you ever wondered what would happen if the world's money system just broke? Well, we might be closer to finding out than you think. A massive shift is happening right now, and it involves a group of powerful nations, a mountain of gold, and a plan that could completely upend the global financial order. Stick around, because what I'm about to share could change how you think about money, savings, and especially the future of precious metals like silver. Let's talk about BRICS. That's Brazil, Russia, India, China, and South Africa. But they're not just a club of 5 anymore. Recently, they've expanded, welcoming giants like Saudi Arabia, the UAE, Iran, and Egypt. This isn't just a political alliance, it's an economic powerhouse. Together, the expanded BRICS nations now represent nearly half the world's population and a massive chunk of global GDP. More importantly, they control a staggering amount of the world's resources, especially oil and gold. For decades, the world has run on the US dollar. It's the global reserve currency, meaning international trade is mostly done in dollars. This gives the United States incredible economic power, but the BRICS nations are tired of the system. They see how US debt is spiraling out of control. We're talking trillions upon trillions of dollars. They see how sanctions can be used as a weapon, freezing countries out of the global financial system overnight. So they've decided to build their own alternative. What's their big plan? A new currency, but not just another piece of paper. They're talking about a currency backed by real, tangible assets. And the number one asset they're hoarding is gold? Let's look at the numbers, because they are truly mind-boggling. The BRICS countries are not only the biggest buyers of gold in the world, they're also the biggest producers. Think about this. China and Russia are the world's top 2 gold-producing nations. When you add in the other BRICS members, they collectively mine a huge portion of all the new gold that comes out of the ground each year. But they aren't selling it? Oh no, they are stacking it. Their central banks have been on an unprecedented buying spree, quietly accumulating massive gold reserves. Why? Because gold is real money. It has been for thousands of years. It can't be printed out of thin air like dollars or euros. It holds its value when paper currencies fail. This brings us to the heart of the matter, the launch of a BRICS gold-backed currency. Imagine a world where international trade for oil, for manufactured goods, for everything, is settled not in US dollars, but in a new currency that is directly convertible to a specific amount of gold. This would be a seismic event. It would force the world to reevaluate the true value of the US dollar, which is backed by nothing more than the full faith and credit of a government that is over $34 trillion in debt. When this happens, confidence in the dollar could plummet. People and governments all over the world might rush to dump their dollars and get into something real, something tangible. This would lead to hyperinflation for dollar-based economies. The price of everything you buy, from groceries to gas, could skyrocket as the value of the money in your pocket evaporates. This isn't some far-fetched conspiracy theory. It's a logical consequence of a century of printing money without restraint. The bill is finally coming due. Now, you might be thinking, okay, this is all about gold. What does it have to do with silver? And that, my friends, is the billion-dollar, or maybe trillion-dollar question. Silver has always been known as poor man's gold. It's a monetary metal, just like gold, but it's also a critical industrial metal. And its relationship with gold is one of the most fascinating and potentially profitable stories in the financial world. Historically, the ratio of the price of gold to the price of silver has hovered around 15 to 1. That means it took about 15 ounces of silver to buy 1 ounce of gold. This ratio is even embedded in the Earth's crust, where silver is about 17 times more abundant than gold. For centuries, this was the natural order of things, but in the last century, that ratio has been completely distorted. Today, it can take 80, 90, or even more ounces of silver to buy 1 ounce of gold. Silver is, by historical standards, incredibly undervalued compared to gold. So, what happens when the BRICS move sends the price of gold into the stratosphere? Let's say gold doubles, or triples, or even goes to $5,000 or $10,000 an ounce. Do you think silver is just going to sit there? Absolutely not. When gold runs, silver sprints. Because it's so much cheaper, it's more accessible to the average investor. When people panic and look for a safe haven, many will be priced out of gold and will pour into silver instead. This rush into silver will be magnified by another critical factor, its industrial demand. Silver isn't just a pretty metal for coins and jewelry. It is essential for modern technology. It's in your smartphone, your computer, solar panels, electric vehicles, and countless medical applications. It's the most electrically conductive and reflective metal on the planet. And unlike gold, most of the silver used in industry is consumed. It's gone forever, used up in tiny amounts in billions of devices. It doesn't get recycled and stacked in a vault like gold does. We are heading for a serious silver supply squeeze. Demand is already outstripping mining production, year after year. The deficit is being filled by drawing down above-ground stockpiles. But those stockpiles are dwindling. At the same time, the green energy transition is demanding more and more silver for solar panels and electric cars. We're creating a perfect storm. skyrocketing investment demand meeting a massive inelastic industrial demand, all while supplies are tightening. When the monetary crisis hits and gold takes off, silver won't just follow. The gold to silver ratio is likely to compress dramatically. It might not go back to 15 to 1 overnight, but could it go to 40 to 1 or 30 to 1? Absolutely. Let's do some simple math. If gold were to hit, say, $5,000 an ounce, and the ratio contracted to just 40 to 1, that would put the price of silver at $125 an ounce. If the ratio went to 30 to 1, you're looking at over $160 silver. That's a multiple of today's price. The BRICS plan is a direct challenge to the paper money system that has dominated our lives. They are preparing for a world where real assets, not debt, determine wealth. As they accumulate gold and prepare to launch their new currency, they are lighting a fuse under the precious metals market. While gold will be the star of the show initially, the most explosive potential could lie with silver. Its dual role as both money and a critical consumed industrial metal, combined with its historical undervaluation, makes it a unique and compelling asset in these uncertain times. This isn't about getting rich quick. It's about understanding the massive shifts happening in our world and protecting your wealth from the inevitable fallout of a failing monetary system. The move away from the dollar is no longer a question of if, but when. The signs are all around us. The BRICS are making their move, and it's centered on gold. For those paying attention, this could be the signal that silver's time to shine is finally here. Thanks for watching. If you found this information valuable, please hit that like button, subscribe to the channel, and ring the bell so you don't miss our next update. The world is changing fast, and we'll be here to help you navigate it. Stay safe and be prepared.